Before we head in to the market outlook, let's just review some things, some updates for the applied level. For those that have the applied level, you're probably aware of this. For those that don't, let me tell you what you're missing. Under the module for applied asset management, we've opened a new folder called Trading Manuals, and filling out the derivatives section of it right now. Energy derivatives and agricultural derivatives are up. Under energy derivatives, we cover oil, gasoline, heating oil, and natural gas. Under agricultural derivatives, corn, soy, and wheat. Within soy, we cover soy meal and soy oil. And under wheat, hard winter and hard summer wheat as well. I'm working on metals derivatives now, which will cover gold, silver, copper, platinum, palladium, and aluminum. I expect that'll be up in about 2 weeks. In each of these, we look at directional trades and account for seasonality, especially when you get to the energy and agricultural derivatives. A lot on curve trades, because a lot of the smart money hangs out on the curve itself, and some intercommodity trades as well. Coming up in 2026, I should put the date here, we have more Costa Rica seminars. Did some in September and March of 2025, and I'm going in to my last week here in Costa Rica, 6 weeks covering August and September. That is a plane you hear behind me, and during the market outlook you'll hear a couple more planes because, well, I would be outside. Where else would I be? It is 1 week long. Each of the seminars you're here for a week. We cover vol, momentum, and coming up in 2026, I'll be introducing curve trades. It is not very scalable. I can only take 4 to 5 people per week maximum, and you are allowed to bring a +1, a significant other who can, get a vacation in at the same time. We do have day trips for the +1s, and we do have horses on the property now. We have 4 nice looking horses, and we have an ATV if you want to go riding for the day, or if you want to ride some horses or learn how to ride horses, we have that here as well. Here are the weeks that I'm thinking of doing, so if you are interested in any of the weeks, the sooner you let me know, the better, because last year they filled up. I think within 48 hours of announcing them, they were full. Week 1, the 15th to the 21st. Week 2, 22nd to the 28th of February. Week 3, the 1st to the 7th of March. And then I take a week off. 3 weeks in a row is a lot. I take a week off. Then I do 3 more weeks. Then I take a week off. And I might do 2 more weeks at the end of that. Usually after 6, I feel that, it does take a lot out of me to do it. That I'm done for that period of time, but depending on how many people are interested, I might add 2 more weeks. I know it's a long notice time because we're just in September, so we got October, November, December, and January. But last year I announced this, I think, sometime in the beginning of January, and within 48 hours it was done. We were booked, a little overbooked as well. Some weeks had 6. I don't know that I'll do that again. I don't think I'll put 6 in, so I'm really going to hold tight to 4 per week, maybe 5. So with 6 weeks for sure, we're looking at 24 to maybe 30. That would be about it. And if there is more demand, I'm not going to load up these weeks. I'm just going to extend it into other weeks. So if you want some information about this, send me an email at meldrum.m@gmail.com, and I will send you a reply with a sort of a suggested itinerary of what we plan to cover. If you send me an email sometime during the week coming up, I may not receive it. We had a big storm here yesterday, and our meter is intermittent. Sometimes it's on, sometimes it's off. So sometimes I have power, sometimes I don't have power. We're waiting for the utility company to come and replace the meter. Until then, it will be intermittent. So if you don't hear from me right away, I'm not ignoring you. It probably just means I'm out of commission until the utilities get fixed. Okay, let's head in. Let's lead off this week right away with the central bank. We had 4 last week, 2 with cuts, both North American, Canada, and the U.S., 2 without cuts. The UK decided to stay at 4%, and Japan, no increase, given the level of debt they have. You think the U.S. has a lot of debt to GDP. Have a look at Japan. They can't afford to raise rates. Let's have a look at what happened in the U.S. We had a rate cut, the effective federal funds rate on September 17th. Going into the meeting was 4.33. They cut. That takes effect the very next day. So September 18th, we had 4.08. The expectation is for 2 more cuts this year. So the expected federal funds rate, December 31st, 3.58, which is where we get the 3.6 as the terminal rate at the end of 2025. And then it is basically 1 rate cut in 2026, 1 rate cut in 2027, and half a rate cut for the longer run. I've got 2026, 2027, 2028 here, and you just basically find the midpoint. So you take out the high and the low. There's 3 here. You'll take out these 3 over here. You got 4 over here. Take out 3, and you end at that dot there, 3.4, 3.1, 3.1, and 3. Look at this is 2025, and this is this line over here. That's 4%, and this is the 3% line over here. Look at this. Look at that 1 dot all the way down there. I mean, you knew that would happen. As soon as he was confirmed, you knew that there was going to be 1 dot way the hell down there. He's looking at 6 cuts. 50, 50, and 50 was his projection. He got 25. But 6 cuts followed. I'm sure that's him down here, followed by more cuts here, followed by more cuts in 2027. So he did not get his cuts, but who do you think this is up here? And he bets that is Cook saying, no, I'm not budging. I'm giving you 0 now that you've done this to me. He was in this meeting, so he pretty much knows who each dot is. So every dot above his dot, he's going to report. Anybody who is extremely hawkish, I'm sure he ran back to the White Office and the Oval Office, the White House, and said, these are the people you need to target next. I asked DeepThink, Google's DeepThink, to forecast the next likely moves. So we'll have a look at that next. Some things were increased. The June projection for GDP 1.4 is up to 1.6, 2026 up to 1.8, 2027 up to 1.9. So it was upgraded. But if you look at the change in the forecast for GDP, there is only one person, which is new, at 2.6 to 2.7 over 2026 to 2028. It's probably Mirren again saying, oh, GDP growth is going to be fantastic. You got to get that interest rate all the way down, and there'll be no inflation. Now, I agree with the no inflation. I think we do live in a deflationary world, and I do think that interest rate is going to come down for 2 reasons. You have to stop thinking about a rational Fed, and you have to start thinking about an irrational Trump, and the U.S. really can't afford it. And Bessent wants it down anyways, and he wants the whole curve down. Unemployment, no change in unemployment here. 2026, unemployment will actually be lower than their previous forecast, or their previous guess. Let's call these guesses, because they're not very good at this. And in 2027. And inflation, small jump. They're projecting in 2026, or they're guessing there'll be a small jump in 2026, but everything will be okay in 2027. And of course, they will hit their target in the long run, and only hit their target, because why would there ever be deflation? If you look, and I've said this before, at all the past SEPs, go back 5 years and look at an SEP, and then look at what happened. They are terrible at forecasting, some of the worst forecasters out there, yet the market clings to it like it's gospel. They were at 2 cuts at the last meeting. Now they're at 3, and only 1 for next year. That's going to change. So they this is the forecast for their rates. Here it is. 3.6, 3.4, 3.1. In pink is mine. I think 3.58. I don't see why I would have a 50 basis point cut at any of the meetings this year. I think 2 more 25s. But for 2026, I see 100 basis points, not just 1, but 100 as table stakes. I think that's just starting. That would be sort of a base case. A bear case would be slightly lower, but I just don't see a bear case here. So I guess if there's no bear case, my base case is my bear case, but I see 100 basis points there. By the time you get to 2028, the end of Trump's term, you're back at the zero line. I put here, these are mine. You're back at the zero line. And I think that by the end of 2028, U.S. debt will be somewhere around 50 trillion. From where it is now, we're sitting just under 40 trillion. It'll be 50 trillion. And the central bank, I think, will hold some 30% of that, which is 15 trillion on their balance sheet. And they're sitting at 6 trillion now. So over the next 3.5 years, a more than doubling of the size of their balance sheet. We'll see what's going on with reverse repos and reserves. They're dropping very quickly. Reverse repos are pretty much at the zero line now, and reserves are just slightly over 3 trillion. I think they got about another 500 billion before they have to stop. And as soon as Powell is gone, I think that reverses and you get quantitative easing. So this is what we have coming up. I put between now, this is now, you have October 29th, which is another Fed meeting, and then I ended it somewhere between the two meetings. Somewhere in there, you'll have a new Fed chair that's announced. Somewhere between October and November, I think they'll announce a new Fed chair. And then you have eight central bank meetings in 2026, and they're only projecting 1 cut, and 5 of those are going to be ex-Powell. Does that seem even rational to you? Do you believe that? That all of 2026, there's only going to be 1 cut? Maybe the committee is thinking, oh yeah, there'll be 1 cut next year. But do you think that committee is going to be right in any remote way whatsoever? If they put a 0 on the end, I would say, well, you're getting in the neighborhood, probably on the higher end of where I think an irrational Trump Fed would be. But to say 25, when you have 5 meetings ex-Powell, I think you get 25 before Powell leaves. Just 1 more to probably say, look, I got you to the neutral rate. My legacy is secure. What you guys do now is your own problem. And then you have 5 meetings and you're not going to get any rate cuts. I don't believe that at all. Let's have a look at what DeepThink thinks about this, and I'll show you my prompt so you see that I wasn't leading it. I simply just stated some facts and then asked it a question. Its answer is its own. Okay, here is my prompt. I tried to be as neutral as possible by stating the 2 first sentences are just statements that really have no value to them at all other than just being statements of fact. President Trump is attempting to exert pressure on the Federal Reserve to lower rates. He's attempting to remove Lisa Cook and replace her with someone who shares his view of where rates should be. Given the modus operandi of the man, and from everything you can assess of his past actions, what will his most likely next moves be with respect to the Federal Reserve or its governing members? Project what the effective federal funds rate will be by year-end 2026 under your forecast of Trump's expected actions. And then, of course, you have a little disclaimer here. This took about 14, 15 minutes. So let's see what we get. Based on an analysis of Donald J. Trump's established modus operandi, characterized by a fundamental rejection of central bank independence, a strong preference for low interest rates, and a willingness to exert unprecedented public and legal pressure on institutions, his administration is likely to escalate its efforts to gain control of the Federal Reserve. His strategy will focus on exploiting key personnel inflection points and legal ambiguities to replace independent policymakers with loyalists committed to aggressive monetary stimulus. President Trump views the Federal Reserve not as an independent macroeconomic stabilizer, but as a political tool to maximize short-term growth. His established methods include public coercion. Well, we've seen that, right? Relentless public demands for lower rates and personalized criticism of Fed officials to influence decision-makings and shape market expectations. Loyalty-based appointments, nominating individuals based on their alignment with his low-rate view rather than adherence to traditional central banking principles. And challenging institutional norms, testing the boundaries of presidential authority. The current attempt to fire Governor Lisa Cook for cause is an unprecedented move aimed at securing a compliant majority on the Board of Governors. Here are his next projected moves. The legal battle and the precedent, the Cook case. The immediate focus is the legal battle to remove Governor Lisa Cook. Administration is expected to aggressively pursue this case to the Supreme Court. A victory would not only allow Trump to replace Cook with a staunch dove, potentially securing a majority on the 7-member Board of Governors. Crucially, it would set a precedent that governors serve at the pleasure of the president, effectively dismantling the Fed's political insulation. The regional bank presidents, I did not think of this one. So thank you, Deep Think, for this. The February 2026 lever. A critical, often overlooked mechanism for control involves the 12 regional Federal Reserve Bank presidents who vote on the FOMC on a rotating basis. Federal Reserve Act requires these presidents to be reappointed every 5 years, subject to the approval of the Board of Governors. Next synchronized reappointment date is February 28th, 2026. If Trump secures a majority on the Board of Governors by then, that majority could refuse to reauthorize any regional presidents viewed as hawkish. And this would allow the administration to rapidly tilt the entire FOMC towards a dovish stance. And the chairmanship, we know that. Most significant opportunity is the expiration of Jerome Powell's term as chairman in May. Given their history and differing policy views, it is virtually certain that Trump will not reappoint him. The replacement will likely be chosen based on loyalty and a demonstrated commitment to very low interest rates, prioritizing stimulus over inflation control. We knew this about number 3. We knew this about number 1. This is new. That is interesting. Let's see what the forecast is. A Fed operating under this influence would fundamentally change its reaction function. The dual mandate of maximum employment and stable prices would be heavily weighted towards stimulus. Even if inflation remains above the 2% target, the Fed would likely tolerate higher inflation, 3% or more, while aggressively responding to any softening in the labor market. And here's the forecast. Assuming a current federal funds target rate of 4 to 4.25, which is where we are now after the cut, the trajectory under a politically captured Fed would involve a significant and rapid easing cycle. So the end of this year and the first quarter of 2026, 50 to 75 basis points. Well, we know we're going to get 2 more. Well, we don't know. It seems the Fed is okay by saying we expect 2 more, so the market can say, okay, well, there's 2 more, and it's putting in 1 more, which I think is right. I think at least 75 by the time you get to the end of the first quarter. I think that's right. I think Powell would like to get as close to neutral as possible and say, there's my legacy. Q2 to Q4, consolidation of power following the potential overhaul of regional presidents. Installation of new loyalist chair in May, an aggressive easing cycle would commence. The new leadership will prioritize the administration's growth targets, likely implementing cuts at nearly every meeting, potentially in 50 basis point increments if economic data provides cover. Projected cuts 125 to 150. So add the 2 together, you're somewhere between 175 and 225 basis points. I went 200 by October. By the October month, that the effective federal funds rate would be 2%, putting ZQ at 98. It's currently at 97, pricing in the 3% long-term rate that the Federal Reserve is penciling in as their long-term terminal rate. I don't think that is going to happen. Risks. This trajectory carries substantial macro risks. The erosion of the Fed's inflation-fighting credibility could lead to unanchored inflation expectations. This might paradoxically result in higher long-term borrowing costs, such as mortgages, and investors demand higher premium for inflation risk even as short-term rates are forced down. Besant is going to be working on the long end of that curve. The one thing that Deep Think missed on this, it was just looking at the rates, is it did not consider any balance sheet effect. Fair enough, I didn't ask it to project out the balance sheet, but I didn't specifically say anything about regional banks either, and it came up with that on its own. It would have been more complete had it come up with some sort of balance sheet forecast. Now I could just ask it, under this scenario, where do you think the balance sheet will go? My thinking is by the end of 2028, 15 trillion. If the U.S. debt is 50 trillion, I think the central bank will hold some 30% of that, and that's what you're going to need to get that long end of the curve under 3%. Under the forecast that Trump administration successfully asserts control over monetary policy, Federal Reserve will execute an aggressive easing cycle totaling approximately 175 to 225 basis points between September 2025 and December 2026. So its year-end rate by 2026 is somewhere between 2 and 2.5. Let's have a look at the effect of that last meeting on rates and yields. Money market rates all down. We have a 4.08 effective federal funds rate, and all the money market rates are above that, and the 3-month slightly below that. All rates and all yields are lower than they were now than at the beginning of the year, but look at this, we get 25 basis points, and what do you get? You get a steepening of the curve, but not a bull steepening, a bear steepening. I thought that given what we have going on, given the unfolding of what we have going on with the administration, the market would side more, would start saying, well, we have to forecast the Trump effect, not just a rational Fed, but no, it's just a rational Fed. So there we are with a bear steepener on the long end of the curve, not helping my duration position at all. I am getting very frustrated with that. And ZQ did respond at first by going up and then said, no, we believe everything the Fed says, and just ignoring what I think is just sitting out in plain sight for everyone to see. I think ZQ is wrong on this one. I think TLT and the long end of the curve is wrong on this one. They're still forecasting a rational market here. October 29th, all the weight basically on another 25 basis points, 92%, 8% on nothing happening. I don't see that. Canadian PPI we get in 1 day. Durable goods for August we get in 4 days. GDP, second quarter, the final look on it we get in 4 days. That usually doesn't involve a lot of adjustments. And PCE for August we get on Friday. It's going to be a light week in terms of economic data. There's only something really big on Friday, really. And for earnings, there's nothing really big. There's a couple earnings this week, but it's going to be sort of an empty week in terms of direction, or at least earnings and economic direction in the market. Do have some auctions. Tuesday's the 2-year, Wednesday's the 5-year, Thursday's the 7-year, and you've got a whole bunch of Fed speak, 2 in particular that grabbed my eye. Mirren, Monday at noon. Mirren, what's he going to say? And then Powell, Tuesday at 12:35. So those are the 2 big ones, I think. But all the others must have something to say. So we'll see what comes out of that. I'm not going to listen to all of them, but I am certainly going to listen to Mirren and to Powell. I'm sure CNBC or Bloomberg is going to pick that up. That's a big thing, Mirren's first one. Looking at the curve, the 2s to the 10s increased by 7 basis points, upward sloping by 57, and a big move here on the money market to capital market curve is now upward sloping by 11 basis points. Effective federal funds rate now 4.08. Here is the shape of the curve. Q4, 45.5 basis points. We are expecting 2 more. I think most of market participants would say, yeah, 2 seems to be the reasonable number. Q1, 23.5. Q2, 20.5. 22 and Q3 16. So the market itself is looking at the one cut next year and saying that's probably not realistic. We're going to get 2 more in 2025. That leaves 2 1/3 out of 6 meetings to October. There are 8 meetings next year. I'm just looking at this out to October, to the end of the 3rd quarter, and 3 of those meetings are ex-Powell. This is what October ZQ sort of is pricing in right now, and I think that is wrong. So if we look at where it is, 96,995, pricing in a rate of 3%, 108 basis points lower than where we are now, and we're going to get 50 of those this year. So we really need 58 basis points, and I think we get 1 in the 1st quarter. So we just need 1 more cut next year, 1 more, and we have 3 meetings without Powell. I don't know how I can lose on this one. I'm not seeing it. Unless Trump loses with Cook, unless Trump fails to get control of the governors, unless the governors take a stand and show that they're independent by not budging. How many people see that happening? Show of hands that the Supreme Court will tell Trump he can't fire Cook, and Trump will say, oh, okay, I guess, well, I'll go do something else. Show of hands. How many people think that sounds like Trump? I don't think so. Look at your reverse repo, the lowest, $11.36 billion. Effectively, we can call that zero. Reverse repo is pretty much done. Reserves, just a smidgen over $3 trillion. But I would take the rounding error, the 20 billion. I would take that. TGA 807 billion. I think the reserves are going down because the TGA has been going up. We do have a showdown coming by for the end of September, because why would a politician ruin a perfectly good crisis by trying to avert one before they have to, right? Free camera time, screw the people, it's free camera time. So we're going to have that into the end of the month. TLT down 1.03% because why not? SPX up 1.22%, well into the 23 times forward earnings because, well, why not? And the dollar index doing nothing. Real yields all higher. This is a particular important one to watch. The 10-year real yield sitting at 1.75. Break-evens all higher as well. I don't understand that one, other than it is just a mathematical result, and I should read nothing into it. It is a break-even that people who want nominal bonds will take nominal, people who want tips will take tips, and the market's not really balancing nominal and tips in terms of what the break-even is. Because with the low level of cuts that we're getting, with the, I still think, excessive cautiousness of the Fed, we should not see this. But here we are. Investment grade saying, you know what, we're going to go a little bit tighter. Nothing to see here at all. And the mortgage rate, 6.26, that is coming down another 9 basis points. September 24, the low was 6.08 for 2024, 6.08. You take out that, you got to go back to 2022 to get lower mortgage rates, 6.26. Let's see if that happens. Existing home sales, the only data point we have coming up for the housing market. We get that in 4 days. National Association of Home Builders survey, 32. Anything under 50 is contraction. 32. Again, it was 32 last month, 32 this month. Look at this, though. Mortgage apps, that's got to catch your eye. Up 30%. The refi index up 57.7% week over week. Purchase index up 2.9%. On the backdrop of building permits down 3.7% month over month, and housing starts down 8.5% month over month. This is consistent with this. We got a lot of activity going on here, and it's really going from 7% down to here, just some 70 basis points down causes a refi at that level. That is something. Maybe it's I'll refinance my fixed rate for floating rate. I don't know what the mix was, but if we are expecting rapid cuts over the next year, why not get a floating rate mortgage? Let's watch that 608. Home builders, Lennar reported this week, and I guess the market really didn't like what it heard. and it came down from there. I do have some information on Lennar. Let me see if I can find it. I think it was their, what was disappointing was their incentives, the level of incentives that they've been using. I don't know where my screen was, but I was making my notes. Level of incentives, so they took a bit of a dip, which brought the housing home builder sector down with it. Okay, let's spend some time with gold and copper. What if that forecast I had, and that DeepThink has, for where the balance sheet will go and where the Fed funds rate will go, what if that actually played out? Does gold represent a good investment at that period of time? One thing I think that would happen for sure if the Fed pursued that path is you would have a much weaker US dollar. And if those that are worried about inflation says, well, what about inflation? If you get lower yields and inflation goes up, you squeeze out the real rate drops. Well, that is gold's sweet spot. A lower US dollar and lower real rates will send gold up, and we can measure the estimated effect of that. So let's start with gold, and we're going to revisit some level 1 duration statistics here. Gold, 37.19 an ounce. The all-time high was 37.25. We're just $6 under that level. And GC is the contract for 100 ounces of gold. Year to date, it is up 40.39%. The dollar index year to date is down 9.97%, and the real yield year to date is down 48 basis points. Started the year at 223 basis points, ended the year at 175 basis points. So the average, I just taken the midpoint, is 0.199. We can conceive of gold as a perpetual zero coupon bond, which is why central banks like to hold it, because it does have a very real relationship with both the US dollar and the US 10-year real rate. So you can hold US treasuries, or you can hold something that responds the same way, which would be gold. If we think about it as a perpetual zero coupon bond, the duration then becomes 1 over R. So let's calculate the duration. Let's see if this works for us. If the average rate was 0.0199, I'm just using an average. I would have to calculate it every day and calculate percentage changes every day and sum them all up to be more precise, but let's just use an average. That would give gold a duration of 50.25. If you multiply it by the change in the real yield, it should have pushed gold up 24.12%. As the dollar decreases, gold goes up. There's another 10%. We get to about 35%. That given these two variables, just the dollar itself and the real yield, the price of gold from the beginning of the year to now should be up some 35%. Year to date, it's up 40.39%. It does react quite well to the US dollar and the 10-year real yield. A lower US dollar, gold will go up. Lower real yield, gold will go up. So if we think, well, the dollar might find its way to, let's say, by the end of 2026, if we do have that type of rate cutting cycle, you can probably get another 10% down on the dollar index from 96.7 to under 88. And the real yield. If you look at the 10-year and say, well, what if we are successful in getting the 10-year to 3.5% by that period of time? And you think, well, that's only going to stoke inflation. Inflation might be somewhere around 3%. If the Fed is comfortable with 3%, let's say it's 3%, you get a real yield of 0.5. So we can go from 175 to 0.5, or 125 basis points, and we can take our D1 over, and we would use the 0.0175 to get a duration, multiply it by the number of basis points we think that the real yield will drop by, and we can get a pretty good estimate for where we think gold will be. But I don't know that we have to get that precise. We just have to ask some questions. Do you think the dollar will be lower by the end of 2026 under a Trump administration that wants to exert control on the Federal Reserve? If he is successful, then yes, that dollar will be lower in my estimation. And if you do believe that lower interest rate will just keep inflation alive at 3%, the real yield on the 10-year will come down. If they start buying the 10-year to push the yield down, and lower rates do keep inflation at 3%, you will squeeze out that real yield. Lower real yield, higher gold. So if you're thinking that this is only going to cause inflation, you should be getting exposure to gold. This is only going to kill the US dollar. You should be getting exposure to gold. Let's look at copper. $4.60 a pound. HG is for 25,000 pounds. Let's look at some inventory around the world. COMEX, 234,000 tons, highest in 7 years. Week over week, it's up even more, 2.1%. Year to date, up 47.3%. This is the announcement of tariffs on copper. And if mining companies did not hedge a bunch of their production forward, that would, I think, be irresponsible, especially at those rates. They should have seen that it's ridiculous to put a duty on copper, something the U.S. absolutely needs. If you're doing it for national security, you'd want to subsidize the importation of copper. So I think you're going to see this week-to-week increase as mining companies who sold forward actually make delivery. LME 108,000, up from a 2-year low, but it's still fairly tight, up 3.3% over the week, down 11.5% year to date. And Shanghai, we have to look at two levels of inventories. You have 81,000 tons here. This is mainland only, down 3.7% week over week, down 7.2% year to date. And international stocks, 15.6 thousand tons, up 31% week over week. I still think at 460, I still think that we're not pricing in the level of inventory. You're at a 7-year high in the U.S. And it's not coming out as fast as it needs to justify the 460. I still think that 420 is in the works, but rather than sit around and wait, I sold 440 puts along with 430 puts. And if it does get put to me, I do understand that I probably would be writing that down to 420, but I'd be rolling my contracts over. Nice thing of copper, it's I shouldn't say the nice thing. The reality is that the contracts are priced out with carry, and a big part of that carry is the interest rate. So if we think that interest rates are coming down, this curve will start coming down as well, so the level of carry will start to drop. So before the first rate cut, I took the December-March contract and I played a curve flattener on that one. So I sold the spread at 6.05 cents, which is $1,500 a spread, on the anticipation that that curve is going to flatten out. Inventories are elevated at this point. As they come down, there'll be more availability of storage. Storage costs should come down as well, and interest rates coming down will flatten that curve. So I have straight puts as far as the directional play on copper. If it gets put to me, I'm comfortable with that. And I do have a curve trade, thinking that as rates come down, this curve is going to continue to flatten between the December and the March contract. Not a lot of liquidity in these, in the contracts. So if you are playing this, you are buying the December and you're selling the March, very little liquidity. But calendar spreads are listed with a lot more liquidity and really tight spreads. So if you think the assessment of the Federal Reserve is correct, gold is where you want to be, because those are the two variables. And copper as an industrial play, if you think the future requires more electrons to be moved around, not fewer electrons, copper is the thing. Okay, let's have a look at our equity indexes. Chart on the screen is S&P 500. The forward 4-quarter operating earnings, 284.20. Closing SPX, 66.64. Ignore those first three numbers, 666. I don't know what that's all about. I think it's a sign of something, not really sure. That gives you 23.45 times forward earnings. Pushing up to 23 was not enough. Let's push past 23, up from 23.15 the week before. It does come with higher volatility. That is consistent. All-time high, 663.41 on September 18th. The Friday, we had just a little pullback, but we did have triple witching, so there were going to be fights around strike prices, and there were. IWM, what a week it had. 245.54 on September 18th. Nice all-time high on IWM, pulled back to 242.98 on Friday. IJR's got a way to go, ended at 119.26. It needs to take out 126.73. It's got some work ahead of it. And Triple Q ended Friday at an all-time high, 599.35. All-time highs everywhere we look. Gold, all-time high. IWM, all-time high. Triple Q, all-time high. SPY, all-time high. A bunch of stocks hitting all-time highs. Valuation, really, don't pay attention to that, you know. The market doesn't seem to care. Credit spreads, tight. Market sees no risk. So I guess there's no risk. Look at this. They agree, but the dates are wrong. So I know it's a hard task. I know it's brutally hard to do. To look at something objective and to say, oh, the company says it's this date. Let me see now. How am I going to get that done? They said September 19th. Probably means the 18th. I know it's hard. Tuesday, AutoZone and Micron. And Thursday, we have Costco, although Sector Spider seems to think that's Friday. I think we also have CarMax in there on Wednesday or Thursday. And there's a few others that report, but nothing really that's on my watch list that's exciting. Micron had a big run up. It doesn't do well on earnings. So if you're going to play earnings on this one, it tends not to do well on earnings, and it had a big run up on some upgrades. I don't know that its earnings will support that price. If I had to flip a coin and bet, I'd say that probably a gap down rather than a gap up on Wednesday morning. And then Thursday we have Costco. Its guidance, I think, will be a pulse on the consumer, but I don't know that any of it really matters with the way markets respond to things. I'm going to take a few minutes here and slide in FedEx. They reported earnings on Thursday. And down here in Costa Rica with the market seminars, we did a play on earnings vol, and we all did very well. So this is sort of I think an ongoing play that I would want to use for put selling. Q1 2026 earnings, revenue and EPS beat. Their guidance was nice on revenue, a little light on EPS. Guiding revenues to be up 4 to 6%. Market expectation 1.2%. EPS 17.20 to 19. Wide range, 18.10 being the midpoint. Last or market estimate 1821 1825 with 1823 being the midpoint, so little light on EPS. They do point out a $1 billion trade headwind. The loss of the de minimis exemption will reduce shipping, but offset. The expectation is it'll be offset by $1 billion in permanent savings in 2026 due to their network 2.0 initiative. Breaking it down into their segments, FedEx Express revenues up 4% and operating income up 19%. They attribute that to higher domestic packages. Looking at FedEx Freight, revenue was down 3%, operating income down 18%. So give us more of this and give us less of this. That's exactly what they are doing. The spin-off for FedEx Freight, they already have a ticker for it, FDXF. June 2026, they report that spin-off is now on track. We had down here, we had sold the 205 puts against this. You got I think $1.90 per put and this expired the very next day. And I think the implied volatility on this was like 118% on the 205s, and I think it was sitting around 226 before earnings, and these all paid off. But for here, based on its results now, we do a nice little upward sloping chart. I think I would like to sit just below the support line at 220, maybe even 225, and sell the October 2017. The 2025, the October 17, 25, 220 or 225 puts. This one I wouldn't mind if it was put to me. I did have UPS 85 puts. UPS gave back a little that day, but I was able to roll my puts from September to October on UPS. These are networks. You're not just going to start another network. There are two big networks, and there will be two big networks. So I don't see either of these going away. So I'm more than happy to sit in behind their support price and gain some premium. Okay, let's do our AI corner. I gave Perplexity and Google the same prompt. I've had trouble with Google AI mode down here. It only gives me links. In the comment section for the video, I had a lot of people responding saying, but I get the same Perplexity-like results. So I tried it again with just a general question, and I did get Perplexity-like results. So let's see how it stacks up against Perplexity this week with this question. Here's my prompt. Give me a summary of the FOMC press conference that was held on Wednesday, September 17, 2025. Stress any statements about inflation. Because I know they're on the task for the soft jobs data and the softer economic growth. But how are they balancing that with inflation? Let's just go right to inflation-specific details. Powell noted that while overall inflation had eased from its highs, it remains somewhat elevated. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and core PCE prices rose 2.9%. We will see if that's true on Friday. Inflation for goods has picked up, largely due to recent tariff increases, with services inflation showing continued disinflation. That's an important statement. Services, he's saying, look, it's continuing on where it should be going. Goods has picked up, but we have tariffs. This does not seem like an FOMC that is saying, oh my God, inflation. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The Fed expects that tariff-driven price spikes to be a one-time shift in the price level, but acknowledges the risk that the inflationary impulse could prove more persistent. Powell stressed our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. And that's why they didn't go 50. And that's why they're being very cautious to say, look, we agree. It is going to be short-lived, as he calls it. I've always referred to it as short-lived, but okay, short-lived. I didn't go to the same schools. Maybe that's how they say it in Princeton, short-lived. But they're going to be cautious on this one to say, let's just make sure it stops there. Latest projections see total PCE inflation at 3% in 2025, declining to 2.6% in 2026 and 2.1% in 2027. You know what I find shocking about all of this, almost everywhere, is the silence, the dead silence about the deflationary effects of AI. I hear nothing about it. The massive increase in productivity you're going to get because you simply just need fewer people to do the same output. Countries around the world are grappling with the deflationary force of Chinese production by erecting trade barriers to try to keep those goods out of the country because they produce too many. and too much, and it is export oriented, and it will lower prices. If you want inflation to disappear, allow Chinese goods in, but you got to save your economy at the same time. You see the trade-off? We don't want the deflationary force of the cheap goods coming from China, so we're going to trade barriers. But oh my God, inflation, so we got to keep interest rates high for everybody. Meanwhile, jobs not being created because of, I believe, in a large part because of AI, and silence, absolute silence on this one. I find that shocking that to not even give it a head nod, to not even say anything about it. Now, I know they're aware of it. Is it just that the administration is backing Bitcoin and backing AI so that you cannot state what everybody, I think, in the business world can clearly see? This is a job killer. Balancing inflation and employment. FOMC's policy approach now balances upside risks to inflation, downside risks to employment, marking a move from its previous inflation first stance to a more neutral outlook. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. That's why we think it's time for us really to acknowledge that the risks to the other mandate have grown, and that we should move in a direction of neutral outlook and forward guidance. The committee will continue to assess the incoming data and know that policy is not on a preset course. How many times have we heard that? Signaling flexibility in future decisions. That is a plane landing behind me. Policymakers expect the inflation impulse from tariffs to fade in 2026, with 12-month inflation expected to move up for a few more months before moderating as the impact of tariffs wanes. Let's see what Google has given me. They give me a summary of the FOMC press conference that was held on the same prompt, and here you go. Here are the top web results for exploring this topic. I am not getting Perplexity-like results. I am getting a list of URLs, a list of links that I can click on. So I decided to just ask it straight out. Why are you giving me links? Perplexity does so much more. Are you saying I should be using, and I should be using Perplexity in all my searches? And it gives me the key difference, search versus answer engine, and it says why Google might only give you links. Safety and accountability. For sensitive topics like health, legal advice, or financial information, Google often defaults to providing links. This shifts the responsibility of interpreting the information to the user and their chosen source. Also, query complexity, if it's too complex, if it's too new. Commercial queries. Many product-related searches trigger a feed of sponsored links and shopping results. You should use Perplexity instead for research projects, complex explanations, fact-checking, and citation, and use Google for quick facts, finding specific websites, or browsing and exploring. Like when you need really low-end stuff done, we're your man. But if you're looking to get some real work done, you might want to use Perplexity. This is Google telling me this, that you might want to use Perplexity. I don't know. I don't know why I am getting just lists of URL links packaged in a different way to make it look nice. Is anyone else getting this? I know you're not. And you've left it in the comments section that we're seeing something completely different, but I just can't get it to give me anything more than a set of links unless I say, what tree is this, and give it a picture. It'll give me something. But I find if I just leave it in Google mode, I get the AI summary at the top, and then you get all those links below. But if I actually go to AI mode and type in a question in AI mode, I get lists of links, and that's it. Rather disappointing. By the way, on the Google front, on October 22nd, September 22nd. Let me see if I can find my notes on this one here. Where are we on this one here? I think we're here. Give me a second here. Google has a court case coming up. Here it is here. It's the beginning of the remedies phase. They had already been found guilty of illegally monopolizing key markets for publisher ad servers and ad exchanges. So what is the purpose? The trial will determine what specific measures Google must take to restore competition at ad tech following its liability. Expected to last several weeks with testimony from the DOJ, Google, competitors, advertisers, and publishers. The DOJ wants Google forced to divest its ad manager and AdX exchange platforms, separating major components of its ad tech stack. Google argues for less drastic measures focused on interoperability and transparency, claiming divestitures would disrupt digital advertising for publishers, advertisers, and consumers. Expected to last a couple of weeks. They're already guilty of this. This is just what punishment are they going to get? We'll expect that in a couple of weeks, right in the thickness of earnings season, most likely. I don't think we're going to get anything next week on it other than little leaks here and there about this is the argument that this side put up, this is the argument that that side put up. But it'll be a couple of weeks before we get a solution on that. And Google, seriously, this is what you're going to do to me? I mean, I stepped out on a limb for you at 195, telling everybody I think you're worth 230. And well, now you are worth 230, and this is the thanks I get. And here's the thing, I pay for AI Ultra. It was $170 a month for the first 3 months, and then it jumps, all taxes in, Canadian dollars, mind you, all taxes into $384 a month. I pay, and this is what I get. This is the thanks I get for supporting it at $195 and paying it $384 a month. There is injustice in the world, my friends, and it's right here in front of us. Anyways, that's the end of this one.